Harish Krishnan, who's Senior Vice President and Fund Manager, Equity at Kotak Mutual Fund, also joins in with his investment philosophy. Harish, good to have you on the show. Thanks very much for taking out the time. You heard it. We did a quick roundup and got our viewers a complete lowdown on what to expect with GST becoming a reality next week, or the hopes of it at least riding high. How much would the market take away from this reform actually meeting the light of the day?
I think it is a momentous reform because GST has been a long time coming. It's taken more than a decade after it was first tabled in, and a lot of foreign investors have been hoping for this great reform to happen through. So I think there is no two ways about it. That is it a great reform? Absolutely yes. But I guess the nuances of the reform need to be studied in far greater depth. It will be a very naive and simplistic assumption that come one day once GST starts in vogue, you're going to see all these sectors that you were discussing ramp up and race ahead in full glory. So I think there are 2 or 3 key things that we would be looking for. First is of course, when is the implementation date? Passage of the bill is one thing at the central government side. How it gets implemented at the state level is and the passage of the bills at various levels of state government is the second key milestone to look for as far as GST is concerned. More importantly would be the rate of GST, for which there are varying opinions and ranges, but it needs to be seen what comes in. Thirdly, there will be few sectors which will be which have been moved out of GST, how they would react. Fourth, and more importantly, one needs to understand that the initial phase of implementation of GST, in our opinion, is going to be slightly inflationary. It is meant to add taxes to the overall government, and therefore, in a very short span of time, it will add to the overall level and therefore impact demand across the board. So it's not going to be a straight walk that come GST everything is going to look good. But I would reckon that investors who've been waiting this for a long time coming would be more than willing to give a lot of these companies a benefit of rope. They would possibly be able to discount a year down the future in terms of earnings after GST is released, and then look and see whether they are fully priced or there still is some juice left in a lot of these names. So that is how we would be looking at GST from an overall market perspective.
Working with an assumption that this does go through, sentimentally at least, it becomes a big positive. Monsoons are doing okay too. The liquidity gush is looking like it's here for the time being. What are you conservative on the markets right now, or you believe the markets could stay stable and within that there will be pockets of outperformance that could continue for the rest of the year?
I think almost all the indicators that we see as far as market and liquidity and overall positioning is concerned seems to suggest that that there really is some kind of, if I can use the word, a slightly guided complacency at this point of time in the fact that all of these things will continue for a long time coming. I think we've seen a time and again that these things can reverse off quite quickly. Having said that, I think the bigger worry is coming from the global markets, which have also been seeing a significant rally across almost a lot of asset classes. So we need to be watchful on that account. So I would reckon that markets need to consolidate for a reasonable amount of time. If you recall, there were 3 catalysts that we said through when markets kept on falling in Feb and Jan, which was monsoon, GST, and the promise of better earnings. Now we are almost finishing both these catalysts, so we only have the earnings support, which will take some time to play through before markets get the next leg up to move up. So we would think that there needs to be some kind of a cool-off period, maybe over the next 3 to 6 months. But is it anything alarming in terms of the flows that have come in? We would not think so.
Among earnings, what have you observed as a building trend for FY17? We've typically started off the year being more optimistic about how earnings would pan out. That's happened over the last 2 financial years. Do you think FY17 would be a third in Encore, or do you expect that this time it would be different, that the year may start off sluggish, but we would actually edge higher with earnings growth anywhere upwards of 10 to 12%, pushing that range?
I think there are reasonable buffers to build in that 10 to 12% kind of earnings growth for this year as a whole. But you've been right. I mean, at the start of the year, we've always hoped for those teens level in terms of earnings growth, and we've had to see earnings downgrades as far as the street is concerned. I think where we are coming from is that at this point of time, we clearly are seeing a greater amount of resilience and bounce back in earnings as far as the domestically inclined sectors are concerned. So be it in auto, be it in cement, be it in select industrials and capital goods, we are seeing that coming through. It's primarily the sectors which are linked to, say, corporate banking as a whole, where there is a certain amount of uncertainty, which is why I guess the range of earnings expectations for the next year and possibly even beyond is far more wider this time around. But I think there is a reasonable evidence to suggest that the extent of beats or the extent of upgrades is actually on an improving trajectory starting from Q4 of last year.
That certainly seems to be it. So while the house may have cement as its pet theme and the best bet, you personally, what are you most bullish on? Does it coincide with the house, or do you believe in your own sweet way there could be some other pockets that could actually outperform even cement?
I think we're consistent as a fund house that we've got cement as one of our larger overweights. We're equally optimistic on the fortunes of the auto sector. Another area which I think is kind of a contrarian kind of a pick at this point of time is infrastructure. People generally hate this theme, but I think this has got a lot of promise. Again, in infrastructure, we need to keep in mind that there are two broad spaces of infrastructure. You've got asset owners and you've got flow-related companies. I don't think we are there yet as far as the asset owners are concerned. But as far as the flow-related companies are, I sense that we are actually starting to see a lot of traction. So, essentially, companies which are related to the real economy as far as the infrastructure build out is concerned. So let's give some examples, right? We all hear a lot of activity happening in road levels. Now, one way of playing the road levels could be the asset owners, the developers who actually win various projects. Another way would be to play the beneficiaries who will benefit from the spending of these asset owners. So if you really look at it, every road project even today sees bidding from anywhere between 10 to 15 to 30 players. True. So it's just a probabilistic exercise as to who wins what project, which is something which we don't think at this point of time we can take a chance at, right? But on the other hand, there are maybe 6 or 7 large engine companies, or there are 3 or 4 large bearing companies. So there it's far more consolidated. A lot of these companies have invested in the downturn. They've got capacities which are idle. All of these are making of a pure operating leverage, provided that external environment as far as spending is concerned. So I think that is an area which I think is quite underappreciated and hated at this point of time, which we think can be a significant mover from here over a 3-year period.
Find us on Facebook at facebook.com/ETNow and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.